Hey guys, I'm Ellie from FX Scouts. So in this video, I want to show you a very popular and powerful trading indicator, the MACD, or Moving Average Convergence Divergence. And by the end of this video, you should know what the MACD is, how you can use it, and how you can incorporate it into a very popular trading strategy with a very high win rate. Before we get started, please like and subscribe to our channel. It means that we can continue to produce more free content like this. We produce a lot of content, particularly for beginner traders who are just getting started on their trading journeys, and we show them how to choose a broker safely and what trading strategies they can try out. To start off with, what is the MACD? So the Moving Average Convergence Divergence is a trend following momentum indicator, and it shows the relationship between two moving averages of an asset's price. It was developed by Gerald Apple in the late 1970s, and it has become a very popular indicator for traders all over the world. Now the MACD basically consists of three components: the MACD line, the signal line, and the histogram. However, there's a common misperception when it comes to the two lines of the MACD. And it's very important to note that they are not moving averages of the price. They are slightly different. The MACD line is the difference between two moving averages, and it is this line that you can see on my chart in blue. It is basically the difference between the 12 and 26 period moving averages if you're using the default settings. In other words, it's calculated by minusing the 12 period EMA from the 26 period EMA. And this line oscillates above and below zero, indicating bullish and bearish trends. If we look at the signal line, this is the 9 EMA of the MACD line. And on the chart here, it is the orange line, and the purpose of the signal line is to smooth out the sensitivity of the MACD line. So again, the signal line is the 9 period moving average of the MACD line itself. And the purpose of the signal line is to act as a trigger for buy and sell signals. So if you look here at the indicator, the MACD line, or the blue line, is considered the faster moving average, and the signal line is the moving average of the MACD line and is considered the slower moving average. And then if we look at the histogram, this represents the difference between the MACD line and the signal line. It may sometimes give you an early signal that a crossover is about to happen. So if you look at the chart, you can see that as the two lines, the MACD line and the signal line, separate, the histogram gets bigger. And when the MACD line is above the signal line, then the histogram will be positive or green. And when it's below, the histogram will be negative or will turn red. The MACD basically operates on the divergence and convergence of these two lines. Convergence occurs when the moving averages move towards each other, and this indicates that the trend is losing strength, as you can see here. Divergence occurs when the lines move away from each other, suggesting that the trend is gaining strength. Now let's look at how you can use the MACD in your trading. There are several signals that you should look out for. So the simplest way to use it is to watch for MACD line crossovers. So when the blue MACD line crosses above the orange signal line, it generates a bullish signal indicating it's time to buy. Conversely, when the MACD blue line crosses below the orange signal line, it generates a bearish signal indicating it's time to sell. So that's one way to look at it, and then you can look at zero line crossovers. So when the MACD line crosses above the zero line, it suggests an upward trend, and when it crosses below, it indicates a downward trend. And the last way that many people use MACD is for divergences. So divergences occur when the price of the asset diverges from the MACD. For example, if the price is making new lows, but the MACD is making new highs, it could indicate a potential reversal, which you can see occurred here. Now that you know basically how to use the MACD, I want to show you a very specific MACD trading strategy. So this strategy basically uses the 200 period moving average, and it uses the MACD on the default settings. So if you look here on my chart, the first indicator we'll use is the MACD without changing the default settings. I'm using TradingView, so I'll add it as is. Then for our second indicator, we'll use the EMA, or exponential moving average. And here I need to change the settings from 9 to 200 and adjust the style to make the line more visible. Our strategy is now ready, so let's get into the trading rules. Okay, so we'll only look to buy if the price is above the EMA, confirming an uptrend. And as you can see, this is where the price is above the 200 period EMA. Now this is important because we never want to buy in a downtrend. Once we have this confirmation, we'll look at the MACD indicator for entry signals. And a valid signal to enter a long trade is when the MACD line crosses over the signal line, like we spoke about before, and we have a green histogram. These two lines must cross below the zero line for it to be a valid signal. If they cross on the line or above the line, they're not considered valid. If we zoom in, we can see that the cross happened here with a tiny green histogram appearing on our indicator. So we take a long position on this candlestick, set up our stop loss just under the recent swing low, and target 1.5 times the risk. And we can see with that we have a successful trade as the price hits our profit target. And again, if I move along here, you'll see that this worked numerous times on my chart. So here we see the 200 period EMA below the price, so still in an uptrend. Then we see the MACD cross over the signal line below the zero line. So again, I set my stop loss just under the recent swing low, and I target 1.5 times the risk. And there we see it hits the profit target once again. Now for short trades, we only want to sell if the price is moving below the 200 period moving average. This will confirm a downtrend. And once we have this confirmation, we'll look at the MACD indicator for short signals. So a valid short signal occurs when the MACD line crosses under the signal line and we have a red histogram. And this cross needs to happen above the 0 line. So we take a short trade on this candlestick, set our stop loss just above the recent swing high, and target 1.5 times the risk. And again, we see the price hits our profit target. So this is a very popular trading strategy and it has a good win rate, and it's something that beginner traders can very easily use themselves. But if you are a beginner trader, please always use a demo account when you are trying your strategy out and ensure that it does work with the asset you're trading on. And additionally, you also want to backtest the strategy numerous times before you try it out on a live account. Now I just want to give you a few tips for using the MACD effectively. So firstly, look out for false signals. Like any indicator, the MACD can produce false signals, so always confirm signals with other technical analysis tools like we did with the 200-day EMA. Then you may want to adjust the settings for different markets. I use the standard or default settings, which is the 26, 12, and 9 EMA, but you may want to use other settings depending on the market that you're trading and the time frame you're trading. If you're trading a much shorter time frame, you may want to reduce the length of those moving averages. Thank you so much for watching. If you found this video helpful, again, please remember to like and subscribe to our channel for more content and more trading strategy videos like this one. And if you have any questions, please send them through to us. Our website is fxscouts.com, or alternatively contact us on any of our social media channels.